Welcome to Real Estate Hustlers podcast. I'm your host, Josh Appleman. Today we are joined with Salvatore Buscemi, CEO of Brahmin Partners. He's a seasoned investor and author of background at Goldman Sachs, specializes in real estate, private credit, and venture capital, sharing insights on elite investing. Salvatore, if you could, let the audience know a little bit more about yourself.
How are you, Josh? It's a pleasure and a privilege to be here. I am someone who's from New York, a New Yorker originally. I went to school in New York City, and then I worked at Goldman Sachs afterwards because I couldn't cut it to go into med school. I write about this in a copy of my third book called Investing Legacy, How the 0.001% Invest. And I was actually, during my internship between junior and senior year of college, I passed out holding a fibula in the cadaver room with Beth Israel Newark Hospital. And if it wasn't for the hard work that I was doing for the surgeon who was really supporting me to really champion me to go to like a school like Johns Hopkins where he went to, I felt like I was going to let him down. And he said, don't worry. I talked to my brother who just made partner at Goldman Sachs. He's been wanting to talk to you for a little bit. So that's how the story went. I went into the real estate investment banking group. And from there, it was really interesting because you're learning about the stress at that point. And that was right after, we came off of the S&L crisis in the 90s. And there was still like a lot of stuff laying around that had to be fixed. From there, at the age of 29, I went through a little tragedy at 24. I lost my father unexpectedly, and I made a promise to myself. He was 56, and I just turned 50. 50. He was 56. I said I would do something entrepreneurial, and in the world of investment banking and buy side, what that equates to is starting your own fund, not like your friends and family fund where you're doing a 506c, like a real institutional fund. And I was able to raise $30 million from Medley Capital. Back before when things were going really sideways as it relates to the trouble with the whole loans that we were seeing as it related to Bear Stearns and a lot of these banks that were just going up in flames because the CMBS and the RMBS machine stopped working. Fast forward, we did something similar where we were buying. At the age of 33, I raised another $30 million from another friend of mine who was an institution, and we were able to buy fractionalized defaulted hard money loans against commercial real estate. And I wrote my first book, Making the Yield on that. That went as high as $1,600 a copy, but now it's normalized down to $19 because I was able to buy the rights back. And in my third book, I talk about how I was able to transition from doing a lot of real estate to working with families, and a lot of families that I've known, but a lot of families that were investors of mine who were not real estate families, but were life science investors or technology investors. And so how we started working with them and how we built the Brahmin Partners family office with the incredible brand that we're involved with. As I told you before, I was sorry a little late to this call today. We are finishing something up with one of Elon Musk's companies, and we need to get that funded. So we're in the crush right now of getting these opportunities closed. But that's really how it is. When we look at the world, I'll just say when we look at real estate, we look at that very differently than most other investors, and I'm sure you're going to have a slew of questions for me on that.
Let's start back on the real estate investing classes, the institutional grade. What kind of tactics do you learn in that kind of atmosphere?
You learn about things that nobody else will tell you about when you're starting out, like capital structure, right? Or distress, rights and remedies. How to raise the capital, pitch the deal. Because really what it was is a bunch of spinning plates, if you think about it. And each plate, you're trying to cram down all the equity, which is happening right now. You're trying to, maybe keep in place the senior or replace the senior debt with new debt, but also bringing in maybe some fresh equity. So you're constantly spinning a plate. And we would balance probably about 5 of those at a time. And that's how you really learn the mechanics of the business and really things that nobody else would teach you, like exit cap rate or cap rate delta, or, maybe common sense, like interest rates drives entire, real estate cycles. Nobody really wants to believe that, but we're starting to see a lot of multifamily guys just absolutely torch their equity investors because they were buying multifamily on adjustable rate bridge loans.
Yeah, that's definitely coming to. I think there's been a lot of survival out there with pref coming in, and then the hope of interest rates dropping. But that's
not a business plan, though. That's not
right.
A business plan.
It's a hope. But what are you seeing on the horizon with interest rates? on the
I
yield?
think interest rates are going to. I think interest rates, the 10-year will come down appreciably. I think it's going to be probably like so it's always traded within the range of about 4.5. I think it's going to come down a little more. I don't think you're going to see that yet. I think it's going to take 6 months to work through the system with the Trump administration. At that point, things will be straightened out. People have a lot more clarity. You'll start seeing more companies go public at that time, but also I think there'll be a lot more capital coming into the markets. A lot more private capital coming into the markets. And I think that's notably due to several factors. But if you have 1 million people, for example, who are paying $5 million to get a passport to the United States, the only reason why they're going to do that is so that they can move and invest in the United States.
And even not only that, they graduate from their school of choice, and then they're not able to even build businesses here. So that enables them to graduate plus stay here and build businesses. Or Apple pays for their visa, their gold card, and now they're able to build a company up, and that's small time. I mean, times that by how many they're trying to go after, just 1 million.
That's $5 trillion off the budget, right? I mean, that's $5
Right.
trillion off the debt, because the debt is really the most existential crisis that this country has. And people will starve if it doesn't stop. And if it's not taken, if it's not handled correctly, people will starve. People don't want to think that, but it's very easy for America in certain parts, especially the lower middle class, to turn into parts of maybe impoverished areas in Latin America.
Yeah, it goes pay the price today, so you can pay any price tomorrow, and it's all short-term pain of the things that they need to break things in order to fix them, and that's what we're seeing, and I'm all for it. I'll pay the price. I'll pay whatever I need to today.
Me too. And if anyone agrees with this, they can get a free autographed copy of my book if you can give them my email on the link. To send their email address. They can send their mailing address, and I can send it to them.
What's your all stance on the type of assets you go after? Is it value add? Is it core? What's the temperature?
No. We have 13 families that are already rich enough, and family offices, by economic definition, is $100 million plus in AUM, because it costs money. If you think about that as a $100 million yacht, it's going to cost about 1% to 2% per year to manage that wealth. It's not just sitting in a bank account. And I think a lot of people think that there's just a lot of people sitting with billions of dollars in the cash in their checking account while the value of the dollar continues to, evaporate, almost overnight until now. And I think there's going to be some things, but what we're looking for things where it's placement of capital, because a lot of our families have what's called operating companies, Josh. So they have companies that throw off, say, like maybe $10 million a month, and they want to put that into Class A real estate. They want to put that into venture, but more so into Class A real estate, specifically industrial, which I really like, specifically maybe office too. Now that that's starting to come back in certain areas of the country, it's some things that we've looked at. And that's really what really is driving the decision making today, because they're gravitating towards quality. If you've ever heard of the brand Zara, all right, if you've ever seen a woman or maybe man on the street, the owner of that company is Amancio Ortega, and he's one of the wealthiest billionaires in the world. And he buys, I know his family office well, they're in Palm Beach. They bought 2 years ago $1.1 billion in Class A real estate around the world, cash. So they're already rich. They're not looking to get rich. They're looking for a store of wealth with a handsome credit-driven coupon, and using our last. Yeah, exactly. So I mean, you go to bed at night, and really what it is real estate for most people who are the entry-level people is a wealth creation mechanism, right? They flip homes and then they do value-added rehabs. That's a wealth creation mechanism. That's how a lot of families started, and then they just go for the glory. Trump was like that. Kushner was like that. Kushner bought 666 Fifth Avenue. Trump wanted the glory of leaving Queens, going into Manhattan. And that's really because it's built, it enhances the legitimacy.
Yeah. So Brahmin Partners, you all underwrite the deals. You make sure that they're viable in order for family offices to even be.
Yeah, we do a lot more than that. I mean, we do due diligence that's on par of maybe a jealous Latina ex-girlfriend, right? I want to know everything that's going on. I want to know things where, sort of like looking at the phone records. I want to know what the guy's background is when we look at these deals. I want to know that the sponsor, everybody's got issues and stuff like that. But, I don't want to work with a GP who's been a plaintiff against mortgage banks and bridge lenders before, right? I don't want, something like that. And that's really what we're looking at when we put these opportunities together, is that it's not just us, but we socialize it with some of the smartest people I know, because I'm going to be soliciting them anyway. Right? And I think that's what a lot of people do, is that, they can't remove the ego to be able to do it, because everybody wants, especially men, they want to see that they're smart. Whereas with us, I'm more protective of my track record.
Yeah, there's a saying, ego is the enemy, and that's so true. It just wipes away good deals, good potential deals too. And like you had mentioned, you're getting in the room with a lot of other smart people. It becomes very small once you become in a different niche specific industry, and you know who the players are. You know who's interacting with what, and who you really want to do business with. And then even in the deals, the operators are everything. The character of the operator, how they are under pressure, and what their tone is.
Well, that brings me to my 3 rules, right? Good operators turn bad deals into good ones. Bad operators turn good deals into bad ones. But we have 3 rules, and remember, we don't own anything. We don't pour concrete. We're just allocators, sort of like Carlyle Group or Goldman. Does that make sense? Number 1, no first-time GPs. I want someone to have been through at least 2 cycles. 2008 was one. This one hasn't really started or finished, depending on who you want to talk to. I want them going back to like the 90s. I want to see some gray hair, because at that point, that they've been through it, they see it, and they have the resources and the network and the contacts strong enough to help them. Today, any emerging first-time GP is probably in a world of hurt because they don't have access to networks to be able to help them out. Number 2, I want audited financials. And number 3, I want a meaningful co-invest. 5% is cute, but that's sometimes with new operators, they're rolling their fees into the deal to show they have equity, which is really taking money from one pocket and putting it to the other. 10% is thoughtful. Anything more shows conviction. 10% is appropriate if there's additional structure that's being added to the deal, such as they're contributing the land and developing at the basis they bought it 20 years ago or something like that. So, this is the art of the deal, that we all hear about and talk about, but it's really the functional way of doing it. And then also, pari passu, other terms like that. But before we get to that point, those are the 3 rules before I even open your deck. That I'm going to, if you shoot me something, I'm going to shoot it back to you and say, these are the 3 rules.
Yeah, and out of those 3 rules, an operator, what is a true operator? Are they on the GP? Are they managing the property? Do they have their team set up vertically integrated? Construction, property management, asset management? What defines an operator in your opinion?
The people who I work with are usually very wealthy families that have a development arm of around 50 years or so.
Yeah, brand new, Class A, for sure. That's a totally different. So you all are on the development side too, then?
We are. We are just, again, equity allocators, right?
Yeah.
We are. Yes, that is true.
But it's Class A. You're looking for coupons that just throw off for predictable income. Nothing value add. Value creation is presented on brand new asset. Fill it up and let it kick off cash flow month over month.
Mm-hmm. I mean, if you look at multifamily, for example, it's very competitive right now. Like, prices haven't really come down that much, and people are still underwriting to cap rates that just don't make too much sense for me for vintage 70s product.
Yeah,
that's a lot of risk. A lot of good things need to happen for that to work, because the people who gravitate towards that are usually the first-time operators and GPs who haven't graduated yet to other higher-end asset classes, because they don't have access to that capital.
Yeah, you can create a lot of value on older vintage product, but you have to buy it right, and you can't buy it right. You're selling your equity on the purchase.
Yeah. I mean, nobody was basis driven in 2020, right? Nobody. Yeah. And people, there's a lot of opportunities. We're playing that market in more of a differentiated way that maybe goes, maybe for another podcast, where we provide equity facilities to some of these guys, to be able to invest alongside them in some of these deals, because they've been doing it for 2-3 cycles. You know what I mean? Like, this is, but they're not going to hold it long term. They'll just turn it around and flip it. But you have to also remember, like, that Class C older vintage has always been, the attraction to the newer entrant, because you have the government through their GSAs, sort of helping you, provide housing, to Americans. But you're dealing with people who are poorer than you, who you are asking to pay rent.
Yeah, in a sense, fulfilling a need.
That's great, but I mean, are you going to risk your kid's child education with that
Right.
income?
No, I totally. 100%. Yeah, the GPs that have lasted through the cycles, they've definitely earned their stripes. But are they out there looking for your capital?
They are. They are always looking. Everybody's looking for capital today, and a lot of the families have wanted to work with outside capital sources right now in order to expand because they just want to scale. And we've been at the forefront of providing that to other families as their first sort of LP or their first date to the prom. And then through our Brahmin partners, we're able to make really good introductions, but we take a principal investment into the capital structure, usually preferred equity in a lot of these deals that we get into. But it comes to, and this is something that the middle class doesn't understand, is that there's been a tremendous amount of wealth that's been created over the past 5 years. I think a lot of it, 25% of it, is fraudulent, as what we've seen with Dodge. I don't want to get political, but there are people who had all sorts of money, and all sorts of money came from out of nowhere. And capital is a commodity, and just because you have it doesn't necessarily mean I want it from you. And an extreme example of this is SpaceX, a deal I know pretty well. And if you read the news, Elon Musk in 2022 actually shut off the cap table to new investors, sort of as a defensive mechanism against nefarious, maybe adversaries who would be coming in and would probably, cause problem or harm to, his entities. So that's where we're going today. And you're going to see that these, and I write about in my book, Investing Legacy, how the 0.001% invest. But that's really where we're going today, is where it's going to be much more clubbier. And it's going to be more like buying a New York City co-op or a professional sports team, which is something we're moving into shortly as well.
That's what was going to be my next question. You mentioned Elon, SpaceX. What else do you all? What are you all seeing as a shiny object now that maybe no one else knows about?
Yeah, I mean, things that are becoming down. We like working with private directs and world-class companies. So there's probably going to be some more Elon type stuff that we're going to be investing into, which is great. Outside of that, it's going to be real estate. I don't know what that looks like, but it's going to be Class A. We have a few things that I'm looking at right now, but we got to get through this one deal that ends at the end of that we have to get funded by the end of the month. The other thing is that there's professional sports enterprises and franchises, and there's going to be a wealth transfer effect. And we've already seen this with Adelson buying part of Cuban's team. I mean, obviously, Adelson's older, but there's a whole different reason behind that. But that is really the ultimate, what we call statement asset, right? It's not a pretty building. It's like, if you're in there, everybody talks about you, Josh, saying, I know the guy who owns part of the Green Bay Packers, right? Or wherever you are. And that is legitimacy, but it also opens up networking to world-class people that you would probably never invest into, who are like you, who are probably like even better real estate GPs, or, like people top of the game, right? Think about it. I can't tell you how many times I live in Miami right now, and, there's the Palm Beach boat show, and all the billionaires bring their boats down the show. It's just amazing. And you know what they all have in common? They own sports teams.
So there's the club, and it's almost, you're not invited, but this is the club. there's only so many sports teams, and it's exclusive.
Yeah, and with the gambling now that's increasing, and there's all sorts of different rights deals with streaming and television, and there's a fan born every minute. It's just it's something that is never really going to go out of style.
Yeah. No, that's awesome. That insight is awesome, and you've been there, and that's what you get in with these groups. You're invited exclusively.
Oh, I love it. Yeah, I love it.
And you're there to pass information or possibly offer an opportunity that is exclusive, and that's where people stand to benefit by the network effect. Different people that. It's incredible. Tell us about some cool experiences that you have had.
We had an exit last year. We participated alongside the Shimano family. If you're a fisherman or a biker, they make the components, the small components on these bicycles. Josh, do you know that or not? Did you?
I do not.
You never heard of Shimano?
No, I have not.
Okay, if you have a bicycle, look who makes the brakes. Anyway, they make like fishing rod holders that if you do any big deep sea fishing like I like to do, they are like $5,000 rods and reels. I mean, and they're huge. They're the size of like oil drums. So they invested in a company called Singapore Life, which was a fintech company. Really, it was called Singapore Life, but now it has been rebranded to Sing Life, and Sumitomo Life, which is their largest shareholder in Japan, bought them out, and we got a 2.6 net 2.6 net multiple cash distribution a quarter ago, which is amazing. We have some other ones that have come up. One company just got a $50 million investment from the Saudi Sovereign Wealth Fund, and that's I can't talk about that, but that looks like that's going to ping really soon too. And we have another exit coming up soon as well. And with our real estate deals, because we got into them right, we have a 27% IRR on one of our deals, and our investors will, even though the thing's only been throwing off cash for 3 years, they'll probably be paid off before Christmas and just continue to collect the preferred.
So they are in the deal even after the
Yeah.
refi. Okay.
Yep.
Got it. I've seen it go both ways. It just depends on how the structure is of
Well, if you do a refi, then you're really treating them as debt, right? They're not equity investors.
I think pref is dead anyways.
That's a gimmick.
If it's
That's
accruing,
gimmick.
yeah,
Don't get me started. That's an
Yeah.
entirely different conversation.
Yeah, pref is that's a whole other animal for sure. That's cool. What has been some learning lessons that you wish you knew than what you know now?
I think it comes with maturity, but I think what I've learned, and I could see myself with younger guys, is that they're very transactional. They're very hungry, right? And they sort of are a little too aggressive on the first date, if you know what I mean, meeting with a family. And the first thing I do is that I always offer value. I never ask for anything, but when I want it, I know when. I've fed that cow long enough, and that's helped out very, very well. And one of the things I do by doing that is by helping people with their problems. If I met you today at a conference in Palm Beach, that's great. What are you working on? Get through the pleasantries. And you say, well, I'm working on trying to buy this building. I'm like, hold on, let me connect you with, Howard. All right. Howard knows this area in Coral Gables really well. Talk to him. Let me see what he says. And usually these are very, very high end or very well respected contacts in their own right. And so that leads me to one of the rules that I learned earlier on is if the person you don't respect the referral from is making you a referral, you're not going to respect the person that they referred to you. Does that make sense?
Oh yeah, it comes synonymous. It's
Yeah. Okay. Yeah. So, people, and then, oh, this is great. That's awesome. What are you doing? And then before you know it, tomorrow I got to meet with a bunch of guys who are wealthy second gen guys. And I'm going to go up there with a box of books and just sign autographed copies. I don't want anything from them. I'm going to be talking to them like I'm talking to you, Josh, but I'm just seeding that relationship. And then I put them I say, can I onboard you to Brahmin Partners? Oh, sure. Yeah. I'd love to see what's going on. Or at that point, you invite them into your house and you got their attention.
Nice. That's and that's what it comes out to. You feed the cow long enough, and at that point, you're already there, and you're helping the company grow.
Too many people are like pushy. They're transactional. It's like, I got a deck. I call it that. There's a joke in the industry. It's like, oh great, I got another deck pick today. Another deck pick. I didn't want it. It's unsolicited, and I wish you didn't do it. But it's like, hey, I just found you on LinkedIn, or I meet you at a conference, and you send me a 20 megabyte pitch deck on my iPhone text messages. That's so inappropriate. What makes you think I'm interested in anything like that? LinkedIn is terrible like that, but also, so are people. Some of these people that don't have any real social graces at these, cocktail parties.
Yeah, the inbox on LinkedIn, you really can't check it anymore because it's just filled with people and their what they need.
I think that's going to I think that's going to change soon, though. I hope so, but. Anyway, I've heard some rumors that they're going to clean that up.
Yeah, that'd be nice. As far as real estate, I know you had mentioned office. That's people getting back to the office. That helps. What do you see AI doing? What do you see? I see a disruption. I want to see what your thoughts are.
In real estate, as far as AI?
In general, office, people needing office space, employees behind the scenes, because we see what AI can do right now.
I think they're mutually exclusive. I think people coming back to the office for businesses that are front end businesses like buy side, investment banking, and private equity, you're going to have to, until you get to a certain point in your career, you're going to have to work from an office because it's really an apprenticeship. It is, it's a glorious apprenticeship where you just get the crap kicked out of you for 2 to 3 years, but you learn a trade, and that allows you to raise capital on demand because you have a leverageable track record at that point. But as far as AI, I think, there's going to be an erosion and attrition of law firms, accounting firms, and, probably maybe consulting firms too. And I just think that, you're going to get much more if you have 1-star employee that you can pay a chunk of money for, who can do the work of 10 other employees. That's exactly what these guys are going to look for across all the service providers. I think accounting, law, consulting, that's where I see it. But if it's can't be office, it's going to turn into residential. And I think, to get on very far ahead of ourselves, I think at some point, I'm from New York. I lived in Manhattan for many years, up and down the Upper East Side. I think if you look at Manhattan, for example, if they can't come to the office, then you convert it to condos and have overseas investors buy it. So it'll be Millionaire's Island. And I think much of America is going to be like that too, where it's just going to be an ultimate place for recreation and a store of wealth.
Yeah. And I bring up AI just because I see the entry-level positions just customer service in general. Those are being handled by just generative voice conversational AI right now.
Who knows? There'll be more work. The work doesn't end, right? It's just you're going to have one person who's going to be able to handle the job of 10 people.
Yeah. And then it's housing the rest. Are you all, you like office, you like industrial? What's your take on multifamily? Class A, it's got to be.
It's got to be Class A. Yeah. It's got to be Class A in a tier 1 city, really, Unfortunately, a lot of the tier 1 cities are blue, and that creates issues. And we've had a lot of families lose their shirt after the pandemic because of rent moratoriums, which made it prohibitive for them to pay their mortgage payment on these things. So, and that's one of the reasons why I think Signature Bank failed as well. But we don't like it. Our families don't like it, except if it's in a very specialized. And I don't want any multifamily solicitations. Except if it's Class A and it's you have a lead investor in there who I can't wait to meet in New York City or something, then it becomes attractive. But it has to be in an area where there's higher income jobs. We are not workforce housing. We're not Class C. Class D, definitely not. Class B, no, we're not. And the reason is because our investors are already rich and they don't want tenants poorer than they are.
Yeah, got it. Yeah,
it's preservation at that point. Yeah, it's preservation at that point.
You had mentioned you don't know if you haven't seen the cycle start or finish yet. Do you think there is going to be one here?
Yeah, I think so. Yeah, I think so. Yeah, I do think so.
What do you think? What do you think would stem that? The interest rates, I feel like they're steady.
No, interest rates are steady. If there's any sort of a market sell-off in the equities market, I think that could have some sort of a negligible, but maybe more of a material effect there. Right now there hasn't been any bank failures. There's been maybe one or two, right? But those are like internal operational errors. Those weren't systematic or systemic errors that were happening. All the banks are flush with capital right now. And what they're doing is that they're putting a gun to the head of all the owners to say, you got to give us some equity or, we're going to accelerate the sale or accelerate the note. You got to give us some equity. Otherwise, we're going to accelerate the note. Banks are flush. There's no issue here. It's just that I think there's going to be a lot of supply hitting the market for multifamily with weak, inexperienced sponsors who are doing this the first time and lost it. LP equity is going to be wiped out. It already is. But I think that's really what's going to be, some of the driving forces as it relates to distress in the market. It's the same as it ever was, right? and once people understand that it's a cycle, then they're like, it becomes evangelical to them, which is ridiculous when you think about it.
Yeah, no, it's I know we've got a administration that is. They're very, very business focused on creating things, creating jobs, opportunities, making sure that the market is going to be pumping. So it's going to be an interesting 4 years. It's going to be good 4 years. I feel like we'll see. One last question: if there's something that you could have done different, what would it have been? And just for learning lesson from the beginning real estate investors that are listening.
I would have started building a personal brand much sooner. That's what I would have done. I would have networked a hell of a lot more. I live in Miami and I oscillate between here and Palm Beach. So the networking is amazing. But I would really, living in out west for a while, the networking wasn't that great, and I feel like I sort of got left behind in school. Even though we got deals done and stuff like that. But right now, we've been able to be very successful with many investors, and the reason is because I'm in close proximity to them. So if you have free agency and you can move to a town where there's a lot more action and a lot more finance, a major tier 1 city, I would say definitely do that.
Go where the money's at.
Go where the money's at. Yes.
Interesting. Good advice. And a personal brand, that's your legacy.
Yep.
Cool. If somebody can email you to get your copy of your book, what email address can they use?
I'm going to give you an email address. It is sal@investinglegacy.com. sal@investinglegacy.com. Put your mailing address there, and we will, ship you out a copy of a book, maybe a hat too that says Brahmin Partners on it.
Cool. Sal, definitely appreciate you coming on the show. Look forward to following you, and we'll talk soon. Thank you.
Same, Josh. Thank you kindly.
Yes, sir.